Can you actually believe the tape? One of the most cash-generative monopolies on Earth, and a premier AI pioneer, Microsoft, just flashed fresh 52-week lows after a brutal 33% plus peak-to-trough markdown this month. Chasus are screaming that the AI trade is dead and that Microsoft has lost its mind with an unhinged $190 billion Capex model. Yet, at peak macro panic, Friday printed a monster 5.71% squeeze. Is this a dead cat bounce or a structural reset? Bottom line, this dump wasn't a fundamental failure. The street panicked because Microsoft is aggressively deployment-heavy. Management scaled their 2026 Capex to $190 billion, adding a $25 billion premium for the AI corporate arms race. If you'll love front-running institutional block flows and secular tech trends, smash the like button and subscribe. To track our live trading desk metrics and community chat, hit the link in the description. Real Alpha maps out during peak fear. Advanced GPUs, dense memory, and server components are seeing massive inflationary cost spikes, forcing data center costs through the roof. CEO Satya Nadella has a binary choice: conserve cash or scale out liquidity to lock in monopoly dominance. But Wall Street bears hate heavy upfront hardware costs without near-term monetized yield. Fast Money aggressively unhedged Mag 7 positions, forcing over $600 million in net outflows from the MAG's ETF, shrinking its AUM straight down to $3.6 billion. Fascinatingly, this rotated liquidity rushed straight into pure play DRAM. Hardware memory suppliers like Micron, SK Hynix, and Samsung are going completely parabolic. The street prefers buying the physical shovel sellers over cash-burning tech giants. This explains why MSFT took the heaviest hit in the Mag 7 basket. It's not an operational failure. They are simply the most aggressive player on the tape, deploying astronomical capital to build out high-compute data center infrastructure. Is Microsoft actually broken? Absolutely not. As your cloud growth is accelerating, AI demand remains explosive. OpenAI's infrastructure needs are scaling, and enterprise adoption is white-hot. No core operational metrics are deteriorating. The street's sole anxiety centers on the exact ROI timeline. A $190 billion Capex run raises fears that if software monetization lags, near-term free cash flow margins will face heavy pressure. This specific macro narrative triggered the block selling. But look at the flip side. If artificial intelligence achieves massive secular expansion, this $190 billion deployment becomes a legendary victory. All AI platforms require raw compute infrastructure, and Microsoft controls that foundational layer. Right at peak panic, the order book flipped with a swift 5.71% grain close that prints heavy institutional block accumulation. After absorbing a 33% technical correction, smart money is aggressively bidding the discount. Bloomberg consensus models maintain a target spread from a $400 floor to a $680 ceiling, averaging $563. Trading at $372, the tape implies a massive 50% plus structural discount, keeping long-term institutional targets deeply bullish. Our trading framework is locked. Short-term Capex anxiety means elevated volatility will persist. But on a 3 to 5 year macro runway, MSFT is the premier AI beneficiary. Very few tech monopolies can deploy $190 billion to control the future. Let's test your conviction. Does this 33% drawdown signal the death of the secular AI cycle, or did the market just hand long-term alpha seekers a generationally cheap discount coupon? Drop your tactical play in the comments. Subscribe and smash the like button if this macro breakdown gave you an edge. For our exact risk parameters and high alpha community desk tracking, check out the links in the description below. See ya on the next tape.